Are we in an AI bubble? I think that's what I've been hearing for the past week now. We see trillion-dollar companies, labs talking about 50 to 100 billion training runs, hyperscalers pouring more into data centers than most countries spend on infrastructure. I'm over here thinking this might feel bubblish, but I don't think this is a classic speculative bubble. And to explain why, we need to look at who is paying and how they're paying, and what they're actually buying. And I'll lean on to some points Dylan Patel, if you guys heard of him, has made about the AI build out actually means. When people usually say AI bubble, they mean some mix of either valuations totally disconnected from fundamentals, or easy money and leverage juicing the party, tons of capital and chasing buzzwords. Think .com stocks in 1999, or the housing in 2006. If that's your mental model, then AI does rhyme with it in some ways, but the capital structure and the economics are very different. First of all, who is actually funding this? The first difference, in a classic bubble, you often have weak marginal players borrowing aggressively. In AI, the people doing most of the spending are these big companies: Microsoft, Meta, Google, and a few hyperscalers and infrastructure players like Oracle, CoreWeave, and others. And even sovereign wealth funds like oil states, giant pensions, mega VC funds, Hoya Capital. This is not your cousin day trading stocks or pets.com with margin. Take Microsoft as an example. They're committing eye-watering sums of AI infrastructure, tens of billions in direct capex, plus tens of billions more via partners like Oracle, CoreWeave, or other data centers. That's huge credit exposure to AI, but it's coming from one of those profitable companies in history with a fortress balance sheet. And crucially, most of this is equity and cash flow funded. So not highly leveraged debt. It's the 90s. A lot of the .com exuberance was debt financed or fueled by tiny unprofitable companies issuing garbage stock. Today, it's the opposite. The world cash machines are recycling their profits into GPUs and data centers. That doesn't mean there can't be overinvestment. It just means that fragility looks very different. Revenue doesn't matter, at least in the short term. One of Dylan Patel's, if you guys don't know, he's a very highly respected analyst in this space. He most interestingly points out when he keeps saying revenue doesn't matter in the near term for deciding if the build out continues. He doesn't mean revenue is irrelevant forever. He just means CapEx and revenue are on a lag. So what do I mean by that? You spend billions in 2023 to 2024, two big clusters, train a model 2024, launch it late 2024, and only then do you see revenue ramp through 2025 to 2026. The cash comes years after concrete and copper. Starting at 2024 AI revenues versus 2024 capex and a screaming bubble. It's like looking at a half-built fab and asking why isn't it printing money yet? So you get my point. The right question is, for the last big wave of CapEx, did the return on investment show up? On that front, the early signs are actually surprisingly strong. Return on investment capital, it looks to be for the big tech firms, has gone up since they've started pouring money into AI in 2022. This means better ad targeting and measurement of Meta, Copilot, and productive features at Microsoft, search plus ads plus infra at Google, logistics and recommendation improvements at Amazon. You can argue how much of that is AI versus everything else, but if this were pure madness, you'd expect ROIC to collapse, not rise. Here, I'll give you an example. The GPT-4 economics. Look at one flagship model. Patel notes that GPT-4 likely cost on the order of hundreds of millions of dollars to train. Around 500 is a reasonable ballpark. It has already generated multiple billions in recurring revenue. So you have training cost is about $500 million. Model revenue is multi-billions on a recurring base, plus second order benefits, secure platforms, and new SKUs, pricing power, ecosystem lock-in. Now, if that ROI profile holds for the next generation, say GPT-5 costs 10 to 20 billion, to build and spin off tens of billions in revenue over its life, that is aggressive, but not obviously irrational. It's closer to building a fab node at TSMC than building a tulip bulb. A Bulb is when people pay crazy prices for assets that don't cash flow. Here at early flagships, assets are cash flowing. This is what I call the Pascal's wager for CEOs. Now, another idea of Patel leans on is basically Pascal's wagers applied to AI capex. For big tech CEOs, this payoff matrix really looks like this. So if you overinvest in AI, if AI overwhelms you, wasted some capex, maybe write down, maybe your multiple compresses. If your AI works and you win, you could become the dominant platform for a new computing paradigm. Now, if you underinvest in AI, if AI underwhelms, you save some money, but nice, not life-changing. If AI works and your competitors bet big, you're dead. This symmetry explains why Satya, Sundar, Zuck, etc. keep saying the versions of the risk of underlying investments is worse than the risk of what we're investing. And I'm reading from a excerpt from Dwarkesh. This isn't pure FOMO, it's game theory in some sense. It's an arms race for intelligence as utility. The rational move is to over provision. Could be wrong based on all the information I've seen, especially when you're spending massive existing cash flows rather than borrowing at 20%. So even if the market eventually decides someday today's valuations were too high, the strategic logic of the investment is sound from their point of view. Is this private capital flow actually insane yet? Now, a lot of people imagine there's already infinite fire hose of dumb money funding anything with LLM in the deck, and that is real froth. But let's just zoom out a little bit. Patel estimates private capital is flowing into frontier AI, and associated infra is on order of 50 to 60 billion per year right now. Those numbers do seem pretty accurate if I look at them from a holistic point of view. During the late 90s .com bubble, private markets were reportedly burning more like 150 billion per year in a smaller economy, and much more of it was junky, high leveraged, or attached to companies with no path to profit. So by historical standards, we're not even at peak stupidity yet, and this time a large share of capital is coming from hyper profitable incumbents, so not speculative startups levering up. So could it be an overshoot? Absolutely. If this is a bubble test, are we in 1999 again? The answer is on raw capital numbers and leverage, I don't think so. Another difference, AI CapEx builds real durable assets. So you have the power-hungry data centers, the long-lived substations, cooling and networking, advanced fabs, packaging and lines upstream. Even if some of the GPU demand turns out to be overestimated, the power grid upgrades still exist. The fab capacity still exists. Even the network and fiber still exist. So historical big bubbles are around new infrastructure, railroads, telegraph, even the .com did end with crashes, but they also left behind an incredible valuable fixed capital. Patel's line here is basically, you often have to blow a bubble to get real stuff built. So worst case, yes, maybe some AI build out is overdone and we get a down cycle. That's very different from, say, ICOs on top of nothing. So the real question is, does intelligence keep getting cheaper and better? Pretty obvious in some sense. The last few years, GPT-3 versus GPT-5, I'd say it's a pretty intelligent gap. All this rests on one core assumption. Intelligence per dollar will keep improving, and when it does, usage will explode. Every time model gets smarter, people route more tasks through them, prices come down, new use cases become economical, demand unlocks. If that continues, even at a slower pace than recent years, then the current CapEx is basically front-loading the build-out of intelligent infrastructure the world will use for a decade. If it stops and say GPT-6 disappoints, scaling laws break, or we hit hard limits much sooner than expected, yes, we'll have overbuilt data centers, idle GPUs, write-downs, and some brutal down rounds. Notice that that's not unique to as an AI bubble. It's what happens when you invest in the technological S-curve, and then the curve flattens early. All in all, is this an AI bubble or not? If by bubble you mean prices totally divorced from any plausible cash flows, leverage-driven mania by weak players, or speculation on empty assets that don't produce anything real, then AI doesn't really fit. Early flagship models already show strong economics. GPT hundreds of millions of cost, but billions in recurring revenue. The money is coming from extremely profitable giants and deep-pocketed sovereigns, not over-levered minnows. The CapEx is building hard infrastructure, data centers, power fabs that remain useful even if demand forecasts were wrong. What we do have is a massive global coordinated bet that intelligence get dramatically cheaper and better. The cost of underinvesting is much higher than the cost of overinvesting, and that even if there is a bubble-ish overshoot. The burst will even leave behind the backbone of new computing era. So instead of asking, is AI a bubble? I think the sharper question would be, are we overpaying for the first real global market in machine intelligence? Or are we still underestimating how big the markets get if these systems keep improving? If you think the intelligence will plateau soon, then yes, this might look like overbuild, eventual pain. But if you think the early chapters of AI capabilities, then what we're seeing isn't a bubble. It's a rational, if wild, land grab for the cheapest intelligence the world has ever seen.